So you're looking into these HHFDC affordable units. You're seeing that price tag, but you did see a lot of these strings that are attached, rules and regulations, 10-year buyback period, shared equity, all of these things that you can and can't do. But what if I told you there's a couple loopholes where you could skirt around some of those, or at least diminish some of those strings that are attached? Well, I'm gonna go over that in this video today, how somebody who's quite savvy and maybe has some extra cash to the side could buy one of these affordable units, but maximize their returns on those affordable units. So stick around to get all the details. See you on the other side. What's going on, guys? In this video, I'm gonna go over two loopholes, legal loopholes nonetheless, when it comes to the HHFDC affordable unit program. And you may have seen these. I've been making some videos going over Kahuina. This is one of the projects that we are focusing on lately because they are about to release their HHFDC units in January of 2026. So if you have any interest in that, feel free to reach out to me. There is a lot of specifics you need to understand and things you need to do to prepare, because it's gonna be on a first come, first served basis. That means if you're not prepared, if you're not qualified, and you don't have your paperwork in order, as soon as they open up those gates, if you're not in line or set yourself up for success, you may not swoop on one of these things. So if you wanna get set up for success, feel free to reach out to me. I've got my contact information right here, or you can directly DM me on any of my social media platforms. Okay, now before we go to these loopholes, if you're not already educated on this, I'm gonna educate you right now on what the HHFDC program is, but more importantly, what the strings attached are and how we can diminish some of those strings that are attached. So let's go over what those are. So the first one, can't beat this, you have to be a Hawaii resident. So the HHFDC program is to provide local housing. So obviously one of the restrictions is that you must live in as your primary residence and you must be a Hawaii resident. The second one is that you need to qualify based on the AMI 120 to 140% of the AMI income. That's the area media income. So you have to qualify based on that. You can't make too much money. Again, this is for affordable units in Hawaii. It's pretty crazy. You can see on the screen right now what those amounts are. But as you can see on the screen right here, you need to make no more than this amount depending on the amount of people you have in your household. So if it's you and your partner and you have 2 kids, that would be a 4-person household. Even though the kids aren't working yet, that is a 4-person household income. So that kind of increases that max limit. You also have to not own a primary home in the last 3 years. That is also a requirement. Again, this is generally focused on first-time home buyers, but if you bought a house, let's say 4 years ago, you still would technically qualify for this program. You do have to put a 5% down payment. Can't get around that, but that is a requirement and much lower than the market units, which is requiring 20%. Additionally, you have to live in that unit for 10 years as your primary residence. That means you cannot leave after 3, 4, 5, 7, 8, or even 9 years and rent it out. It has to be your primary residence for 10 years. Very important piece. Additionally, there is a 10-year buyback period. So if you decide you want to sell your units before the 10 years, you can't sell it on the open market quite yet. The developer has the first right of refusal to buy that unit essentially at the price that they want. So you don't have access to the open market and being able to sell it to whoever you want at whatever price. Another requirement is if you do decide to sell it, you can only sell it to people who qualify, similar to you, to the HHFDC program, at least within those 10 years. After the 10 years, you can sell it to whoever you want. And another requirement, or at least restriction, is that you do have shared equity program attached to these units. So what does that mean? That essentially means that if you buy this unit, you're gonna get it at a discount. The developer's hooking you up on the front end, but on the back end, when you decide to sell this, whether it's within the 10 years or after the 10 years, they're gonna take a piece of that pie. They're basically going to say, hey, you own this unit for 5 years, or maybe you own it for 15 years. It's attached to the deed. They're gonna figure out how much equity is in it, and they're gonna say, okay, we hooked you up on the front end, you have to pay us back on the back end, and we're gonna take 10%, 15%, 20% of the proceeds from basically your equity once you sell the property. So that's a big piece, and we're gonna discuss one of those loopholes on how you can minimize that and maximize your profits. Okay, that's the HHFDC program and some of the restrictions and things you need to know. Again, I've got a video right here that kind of goes a little bit more in detail on that program. But what I wanted to discuss is some of the loopholes, and that's why you're here. So let's go over 2 of the major loopholes, legal loopholes nonetheless, so you can maximize your profit as well as lower your monthly payment when it comes to owning one of these units. So the first loophole is to remove PMI. PMI stands for private mortgage insurance. So when you pay your mortgage payment, there's essentially a couple things that make up your mortgage payment. You have we usually use the acronym PITI. That's principal, interest, taxes, and insurance, okay? So one aspect of that insurance is gonna be the PMI. That's gonna be that private mortgage insurance. And basically you have this additional payment attached to you until you have at least 20% equity in that home. And since you're only putting 5% down, you still have 15% equity that needs to be built up in that home before you can remove that payment off you. But what if I told you that we can actually get it removed almost immediately? Well, I have a lender who's very creative and has a loophole on how we can do this, and I'll explain to you why this works. So essentially what happens is when you buy one of these units, let's say you buy an HHFDC unit for $700,000. Well, they're gonna send out an appraiser, or at least the lender is gonna figure out what's the value of that unit on the market priced units. They're gonna figure out what's the value of that unit based if it was sold on the open market, not the HHFDC. And generally that's gonna come at least 15% higher than what you paid for it. So you put 5% down, you now have an appraisal to the lender that says it's worth 15% more, and now you have 20% equity in that unit, at least in the lender's eyes. So now the lender is gonna be able to remove that payment off you. Now this only works with certain lenders and with certain programs, but with Kahuina, I have verified with my lender that he can do it with this program, and he can actually remove that payment, lowering your monthly payment. So that is a legal loophole that you can utilize to lower your monthly payment and essentially lower your loan to value, or what we call LTV, not to get too geeky. Now the second loophole is how to lower the amount that you're gonna owe the developer when it comes to that shared equity program. So how that shared equity program works is essentially they're gonna take what you bought it out, what the appraisal value is, and find that percentage in between, and then that percentage is gonna stay throughout the units. Now, what if I told you there's a way we can actually lower that? You can't get away from the shared equity, but there's a way to lower it. This is how you would do that. Okay, I'm gonna be throwing a lot of math at you, but I will support it on the screen and walk you through it. But this is an important part when it comes to saving money. You unfortunately have to do some math. So let's jump into how the shared equity is actually calculated and how it could benefit you, because you are allowed to pay that shared equity off early, how it could save you thousands of dollars if you do that. So let's get a full understanding of this. So the first thing that they're gonna do is they're gonna figure out the shared equity percentage. That's gonna stay stable. That's never gonna change throughout the ownership, right? But that's gonna be the percentage that they're gonna utilize to figure out how much the developer is gonna take out of your pocket, at least one part of the formula. So how they do that is they basically say, hey, you bought it for 600,000. Market price for this, if it was on the open market, we appraised it, is 700,000. So they basically do that calculation. It comes out to about 14.3%. This is just for this example. So that 14.3% is going to follow you until you pay it off. Whether you pay it off now, pay it off in 10 years, 15 years, 5 years, whatever it is. So that's an important part to understand. So let's run two different scenarios. You first have to understand, this is the loophole here, you can pay that shared equity even if you don't sell the unit. You don't have to sell the unit to pay the shared equity. You can pay it off whenever you want. It just has to be before you sell the property or when you sell the property. That before part is the important part of how you can save some money. So let's say hypothetically that, again, property is worth 600,000, appraised for 700,000. You get that equity portion amount difference. It's about 14.3%. That's what's gonna stick with you. Now, if you were to pay that off immediately before the value of the property goes up, you take 14% of 600 minus 700, which is 100 grand. So $14,300. That would be your shared equity portion that you have to pay off. So you have that extra money, pay it off immediately. Well, why would you do that? Well, what most people are gonna do is they're not gonna pay it off immediately. Maybe because they don't have the money for it, and that's gonna be a lot of people's scenarios. But if you do, I would highly suggest it, because this is what can happen over time. And this is what the beauty of real estate is, but why the developers are actually doing this program is because they can, basically hook you up on the front end and then get their money on the back end. Is that if you wait, let's say 10 years, 5 years, and the value of that property, let's say the value of that goes up to 900. Well, now you have a $300,000 delta opposed to 100,000. So it's gonna be 14.3% of 300 grand that you're gonna have to pay out back to the developer. So that's $42,000. That is a big difference from $14,000. Now, mind you, you're gonna have equity in it. You're gonna be getting money from selling the property at a much higher price point, and you'll have those proceeds to pay them. But obviously you'd save a lot more money if you had the extra cash up front and you paid it sooner rather than later, because generally real estate out here in Hawaii, the values go up. And so I would bet on the market that if I had the extra money, that I would pay it off immediately. Because I'm always betting on real estate out here in Hawaii that generally, because there's only so much space, the values generally go up. Yes, it'll go up, it'll go down, it'll go like this, but it's always gonna kind of trend up. So if I can pay it sooner, that's always gonna be the best bet. But again, it just really depends on your financial situation. So those are the two major loopholes when it comes to the HHFDC program, and how you can maximize your savings and also maximize your profit when you sell the property. With that being said, if you guys have any other questions about Kahuina, new developments, HHFDC, or anything when it comes to real estate out here in Hawaii, feel free to reach out to me. Got some boots on the ground. Got my contact information right here. You can DM me on any of my social media platforms, or if you prefer, go check out my website. I got a lot of great resources on there patricklongleyrealty.com, and feel free to contact me there. There's a contact form there, fill it out. Me or one of my teammates will reach out to you and we'll help you with whatever your real estate needs or questions are. So with that being said, I'm Patrick with patricklongleyrealty.com, powered by eXp Realty. Hope you have a beautiful day. We'll talk to you soon. Aloha.